Financial stability now clearly being the top mandate when it comes to the Fed, when it comes to other central banks. But the question is the bigger risk of financial instability now coming from systemic risk in the banking sector or from a misstep when it comes to taking the pedal off the inflation fight?
Hi, Heidi. Great to be back with you. So let's just start off with how we view the SVB drama itself. We don't see it as a systemic risk, especially given the quick response from US authorities to stabilize confidence and that there now appears to be a de facto guarantee on all deposits of troubled banks. The problems don't seem to be shared among the larger banks in the United States. SVB's business model was unique versus, let's say, their peers across three dimensions. The first is that the liability side saw its deposit growth some 4 times greater than peers. SVB benefited greatly from liquidity inflows from highly speculative sectors, namely tech. And it's clear that there are some serious miscalculations going on with regards to their risk management, namely the unhedged fixed income component of their portfolio. So if you look at the broad market indicators of systemic stress, that also supports our view. Really far from screaming material stress in broader global financial markets. And so we're taking a rather sanguine view. As to what it means for the Federal Reserve next week, we do think that it's using the right tools for the right job. Macroprudential tools are used for financial stability. Monetary policy tools, namely interest rates in this case, used for the inflation fight. And the CPI number earlier this week suggests that 25 basis points is the right way to go next week. The question is really about the rate cuts that are priced in later on in the year.
Yeah, and it feels like it's a bit too soon given how fast moving this market is to try and determine that. But I do wonder, you talk about being quite sanguine in the face of what's perceived as the range of risks. Does that mean you're being more opportunistic as opposed to being potentially more defensive in this market?
Yes, we're staying quite nimble in this environment, high volatility, question marks around the peak and the Fed. Look at consensus, for instance. It was not that long ago that the terminal rate was 5.7 middle of last week, and now we're looking at something like 4.6 by September. So wild volatility swings here. It does suggest a much more active management approach, and staying nimble and defensive qualities are still our bias.
Given, of course, a rush to safe havens, what happens if we have a stronger dollar for longer than expected, especially among Asian markets?
Yes, so the risk to the US dollar, even prior to the SVB drama, was really one to the upside. We had identified 2 areas that really needed to change to shift that dynamic. And the first was that we needed to see growth differentials narrowing away from the US's favor. We needed to see interest rate differentials narrowing away from the US dollar's favor. And neither of those dynamics were manifest. Now, of course, you have the global rush to safe havens, and that, of course, benefits the US dollar greatly. A rather important detail of the BTFP is that it only applies to US FDIC regulated institutions, and that creates conditions for an offshore dollar situation. And I won't go into the details, but it is a net from our perspective bullish the US dollar.
Are you concerned about some of those banks across Asia perhaps exposed to treasuries that brought down the likes of SVB? We saw significant pressure on Japanese banks, for example, this week.
We think that Asia, in terms of the direct exposure to SVB, is those direct linkages appear to be rather small. SVB provided financing to relatively few companies, not just in Asia, but broader emerging markets. And you do have a number of companies within Asia's venture capital and tech startup sector that have that exposure, but not many have openly admitted to seeing large losses from SVB's bankruptcy. So we're pretty sanguine on that. We think the broader macro dynamic does benefit Asia. It certainly stands out relative to most emerging markets if you consider the fact that growth differentials are expected to widen significantly throughout this year. Inflation in aggregate remains relatively benign. Some central banks are already pivoting dovishly. Look at Vietnam, look at Thailand, for instance, and asymmetric risk to the upside for non-resident capital flows given the drawdowns that we saw last year.
There was not much in the way of encouraging market rallies that came out of the MPC for China, but does the sheer kind of lack of correlation between China and what's going on elsewhere in the world at the moment make Chinese assets more appealing in some way?
It certainly looks like the reopening rally has some ways to run in China. We do note, however, that the economic plans that were detailed at the MPC were a little bit more cautious, a little bit more restrained than the market had expected going into the event, with the relatively lower than expected GDP target of around 5%. And while that may suggest limited upside to economic activity once the mechanical rebound from reopening peters out, it does also suggest that it gives officials more policy space to tackle the structural problems, the financial risks in the economy, and that actually sets it up for long-term, much more sustainable growth.